Thank you for joining us this morning. I'm Linda Shirkey of the Bates Group, which is the sponsor of this panel. Bates Group has been a trusted partner to our financial services clients and their counsel for over 40 years, delivering superior quality and results on a cost-effective basis. We have a professional staff and over 165 financial industry experts offering services in litigation consultation and testimony, regulatory and internal investigation matters, compliance, AML, financial crimes, forensic accounting, and damage consulting. Bates Compliance, our compliance consulting practice, delivers guidance and tailored compliance consulting solutions to our investment advisor, broker-dealer, and hybrid firm clients on an as-needed or ongoing basis. You can learn more about us by visiting Bates' virtual booth at the conference. Also, we invite you to meet with our speakers over Zoom during the breaks at the Bates booth. And now to introduce our panelists. I'm Linda Shirkey, Managing Director at Bates Group and the Compliance Group. We also have Alex Russell, the Managing Director and Practice Leader at the Bates Group. He heads the White Collar Regulatory and Internal Investigation Group at Bates. We have Robert Burks, the Chief Compliance Officer at Brown Capital. Rob, do you want to tell us a little bit about Brown Capital?
Yeah, sure. So established in 1983 by Eddie Brown, namesake. We are an investment advisor with 4 registered funds and parallel strategies and approximately 19 billion in assets under management. We are the second oldest African American owned investment advisor, not to be confused with our friends at Brown Advisory, also in Baltimore, but we are Brown Capital Management.
Thanks, Rob. And then we have, last but certainly not least, we have Valerie Mirko, who's a partner at Baker McKenzie. Tell us a little about your practice, Valerie.
Good morning, Linda, and good morning, everyone. I'm delighted to be here. I'm part of Baker's financial regulation and enforcement practice, and a large part of my practice focuses on advising investment advisors.
Thank you. So, Alex, can you dissect the GameStop story for us, please?
Absolutely. Thank you, Linda. I know we've all been eagerly awaiting our opportunity to get deeper into GameStop. But before we get started, I thought it might make sense to do a quick establishment of a cast of characters. There are a couple names that'll come up. The rest will be obvious in context. But to begin with, GameStop is an American video game, consumer electronics, and gaming merchandise retailer. With physical locations, you've probably seen them in malls throughout the country. Second, Wall Street Bets is a subreddit page founded all the way back in 2012, where participants discuss investing activities with one another. Third, Keith Gill, also known as Roaring Kitty on YouTube, as well as by a username I cannot say in the context of this conference on Wall Street Bets. But he is a former broker who conducted analysis and posted about GameStop on Wall Street Bets, YouTube, and elsewhere. With that, I think we're ready to get a little bit deeper into a timeline of events, though there certainly could be even more events to focus on. Next slide, please. Perfect. So it would be possible to start the story of GameStop much earlier in 2020, but the big change in trading activity follows the earnings reported on December 8th. So that is our starting line here. At that time, sales were reported down 30% compared to the prior year, despite strong activity in online shopping. As a result, the stock would fall 19% from its close on the 8th to close on the 9th, from about $16.95 to $13.66. At that point, momentum seemed to be building and gathering even more strongly in the corner of the short sellers of the security. On January 11th, a little bit of a tide reversal. Former Chewy executives Alan Attal, Ryan Cohen, and Jim Gruby are all named to the board of GameStop. These are viewed as significant additions to the board as they are targeted and directed at bolstering e-commerce experience within GameStop and helping to facilitate that transition away from brick and mortar retailing. The news does make it into Wall Street bets, but the stock overall is flat from closing on the 11th to closing on the 12th. So we don't see a significant uptick in activity. This is more a laying of the foundation for activity yet to come. Fast forwarding to January 13th, this is the beginning of the surge in GameStop's price. Shares rise 57% from closing price on the 12th. And this is tied directly by most commentators back to Wall Street bets, as well as to Keith Gill, who we introduced earlier on in the cast of characters. The stock hit an intraday high of $38.65 that day, 23% higher than the eventual closing price, implying a lot of additional room to run in the security's valuation. Moving ahead to January 15th, on that day, we see short interest in the stock, as the report is provided, down over 13% from the prior reported figure back at the end of 2020 on December 31st. The stock price movement, perhaps beginning on the 13th, appeared to have convinced some short sellers to begin covering at that point, though certainly we'll see there's a lot more additional room to run up and more covering to be done. Moving ahead to the 19th. This date, we get notable short sellers standing by their short loudly and publicly, even going so far as to offer walkthroughs of their research, estimating the fair value of the company to anyone who is interested. The stock is roughly flat from close on the 19th to close on the 20th. So we have a couple days in here where there seems to be no movement in the security price despite news. Once when the shorts make their announcement on the 19th, and then back during the board announcements on the 11th. So we see a couple days where momentum seems to be being tugged in two different directions. Moving ahead, though, to January 22nd, we're going to see another significant upswing, largely driven by options activity as well as outright purchase activity. And that momentum carries the share price all the way up another 51% from about $43 to about $65. Moving along to January 25th, this is probably what you could consider the true melt up in GameStop trading, as a record 178 million shares are traded on that day. The stock hits $159.18 in intraday trading, nearly 2.5 times the prior day's closing price. It ultimately settles at a figure of $76.79, which is still up 18% from the prior day's close, though again, the intraday high was far higher, suggesting additional activity, which of course we do see on January 26th, along with the now infamous tweet from Elon Musk of GameStop, which attracted even more attention to the ongoing short versus long conflict in the security. The price on that day goes absolutely vertical, up to $147.98, a 93% return from the prior day's close of $76.79. This is also the date that notable short sellers, those who were making pronouncements earlier, cover their short positions. At that point, they'd largely had enough. Moving ahead to January 27th, the stock would open at $354.83, up 140% in after hours and pre-market trading. It would eventually close slightly down from that figure to end the day at $347.51. If at all unclear up to this point in time, the momentum from here on clearly favors the long positions. However, on January 28th, several retail trading platforms announced that they will be restricting trading in GameStop stock, preventing further purchasing even. In a volatile day, the stock hits a high of $483 and a low of $112.25 before ultimately closing at $193.60, down 44% from the prior day's close. Representative Alexandria Ocasio-Cortez called the restrictions on GameStop unacceptable in a tweet And in what has to be the first and only occurrence, Ted Cruz agreed with her assessment. On January 29th, the SEC comments on trading in GameStop and other securities, noting that they are closely monitoring and evaluating the extreme price volatility of certain stocks trading over the past several days. The stock opens at $379.71, above the closing price from 2 days prior, reaching all the way up to about $414 before settling back at $325 a share to close on that day. Short interest data is also made available on this date, and it is here that we can see that short positions are down 65% from the levels that were reported on January 15th, supporting the closure of short positions by significant short selling entities a few days prior, or several days prior. Another fun fact for January 31st, the Winklevoss twins of Facebook and Gemini Exchange and crypto fame announced a movie production covering the GameStop saga, further cementing its position in the public imagination. I think there have been several other productions announced in subsequent periods, but the Winklevosses were the first to get in on the action that I'm aware of. However, on February 1st, we begin to see the stock price decline. So the stock drops 31% from 325 down to 225. Intraday trading also suggests that there's a narrowing of the range of activity, perhaps settling back into to a more normal trading pattern. As the stock begins to decline, we also see the David and Goliath narrative begin to emerge for the conflict between retail investors and others active in the security. On February 2nd, we have another sharp decline. The stock opens down at $140.76. That's 37% below the prior closing price. Throughout the day, it continues to fall, ultimately ending at $90, down 60% from the prior day. On February 4th, Janet Yellen meets with regulators to discuss recent developments. The stock drops an additional 42% to $53.50. And then finally, on February 18th, the House Financial Services Committee holds a hearing titled GameStop: Who Wins and Loses When Short Sellers, Social Media, and Retail Investors Collide, which Valerie will be talking about in more detail later on in the presentation. Next slide, please. So having run through a little bit of a timeline, I think we're ready to take a look at some visuals. So here we're looking at the traded volume in GameStop compared to the closing price of the security. The left-hand axis corresponds to the closing price, and the right-hand axis measures the traded volume. It is immediately obvious that the surge in activity in the latter part of January overshadows all prior trading, which demonstrates relatively stable closing prices and consistent or relatively consistent volume. After that period of intense volume, activity seems to be moving back down to its prior levels, though of course, as we'll discuss potentially later on, we did see a spike again on February 24th that shifted both the price and the volume back up into its prior territory. Next slide, please. So here we are looking at short interest, institutional ownership, and failure to deliver for GameStop. The left-hand axis here corresponds to the volume of either short interest in purple or institutional ownership in blue, and the right-hand axis relates to the percentage of failure to deliver shown in green at the bottom of the graph. And there is an interesting inflection point immediately visible where short sellers begin to decline after the end of 2020, and we see institutional ownership start to creep up at that same time. This suggests the possibility that some short sellers not only closed their short positions, but also changed direction completely and went long the security. It's also, of course, possible that other institutional investors, alerted to the short squeeze in progress, moved in to capitalize. As the short activity declined, institutional investors also left the stock, as can be seen in the slight downtick in the blue line on the graph. Finally, we can take a look at failure to deliver. To begin there, I should probably note that failure to deliver can occur for any number of reasons on both long and short equity trades. So there is nothing within the analysis I completed using the available data that should be construed as making any type of claim in relation to short activity. However, failure to deliver can be a reasonable proxy for measuring potential naked short selling activity in which the party that sells short does not actually possess the shares to sell in the first place. The situation will lead to a failure to deliver within 2 days, the maximum allowable time for settlement of equity trades, since the entity or individual that sold short the shares on a naked basis will not eventually have them to deliver. Within the green areas, I've lagged each failure to deliver by the maximum allowable time for settlement, so 2 days, and then associated that failure with the total volume of shares traded 2 days prior to the trade being marked as a failure. To give you an example of illustrative purposes, 799,328 shares of GameStop failed to deliver on January 7th. This would represent approximately 16% of the traded volume of about 4.9 million shares traded on January 5th, 2 trading days prior. So failure to deliver does appear to have been an issue during certain periods in GameStop trading, though notably during the period of highest activity, potentially as a result of short interest dipping down, it does not appear to have been a significant factor, at least based on the data at this time. Next slide, please. Finally, this chart measures the magnitude of the intraday swings in GameStop trading. The orange area above the 0% axis line measures the difference between that day's high and eventual closing price. The purple area below the 0% axis line measures the difference between that day's low and the eventual closing price. It's clearly evident that during the most tumultuous period of GameStop trading, there was significant pressure from both buyers and sellers sending the security price in either direction. The conflict between the two is particularly boisterous during the final 2 weeks of January, as is plainly evident on this chart. Giving you an idea of the kind of trench warfare between both longs and shorts, which certainly was sending the security moving even higher on an intraday basis throughout the most active trading period. So now I will get out of PowerPoint and I'll turn it over to Valerie for a little more discussion on that hearing that we mentioned in the timeline earlier.
Valerie,
Great.
you there?
Thank you, Alex. And I have about 5 minutes to speak to a 5-hour.
So maybe while we have Valerie trying to
I
reboot.
have 5 minutes
there
to
we go.
speak to
Yeah.
a 5-hour hearing.
I think we go ahead with Rob while Valerie, we have Valerie reboot.
For hearing, I'm going to.
So Rob, why don't you go ahead and
Yeah,
talk a little bit
no problem.
about Hester Pierce's speech and what we should know about that.
Yeah, sure. For the next few minutes, I'd like to boil down the data and information that we've just received into some practical application for all the compliance officers in the front, who are on the front line but are in the audience with us today. To set the stage a little, I'd like to highlight a speech given a few weeks ago by Commissioner Hester Peirce at the George Washington University. It was entitled Atomic Trading. In addition to supervising by means of rules, to regulate means to control or maintain the speed of something so that it operates properly. With that in mind, I'd like to commend the commissioner on the tone and the balance of her speech. She was diplomatic and sometimes lighthearted throughout the speech, With the turmoil that was evident by this GameStop and Reddit saga, there was a lot of finger pointing and name blaming going on. Candidly, at first glance, it looked like a pump and dump scheme, but instead of market savvy bad actors, this time it was instigated by a group of seemingly rogue Main Street investors. So imagine me with all 10 of my fingers pointed at them as I settled in with popcorn and soda to read her speech. I thought or was expecting her to chide and ridicule them, but she didn't do that. And instead, she modified my anticipation with her tone and then the balance again. She even tickled me with her revelation about people's peopleness. Let me say that again. People's peopleness. Here's what she meant by that, and I quote: people with their swirling mix of rationality and emotions are unique, interesting, and complicated. People are also fallible, frail, and often tempted to abuse power. People respond to incentives, and any effective and fair regulatory framework has to start with a recognition and understanding of people. Again, with that backdrop in mind, later in the presentation, we're going to offer food for thought to compliance officers as you ponder your policies and procedures in light of these events. So with that framework, Linda, I'll turn it back to you.
So it's not clear to me if the food for thought is going to include popcorn, Rob. Valerie, let's see if we can come back to the hearing.
I am hopeful you can hear me, no pun intended. And I think I now have even less than 5 minutes to talk about a 5-hour hearing. And I also want to discuss a little bit Gary Gensler's confirmation hearing, which occurred just this week, a couple of weeks after the GameStop hearing. But let's start with the GameStop hearing. In a prior life, I spent a lot of time in-house working on Reg Show issues. And as I expected, Reg Show came up in the context of the GameStop hearing. Because really what we saw in the GameStop hearing was a debate about short sales, transparency, revenue generation, and access to markets. And whether there should be legislative or regulatory
Valerie, we're losing you.
to the GameStop hearing and what occurred.
There we go.
Now, here's the important part. There were largely varying levels of expertise amongst both the people asking the questions and the people answering the questions. So I think we saw a lot of very good witnesses who prepped very well. We saw, I think there will be regulatory response, and Gary Gensler's nomination hearings signaled that very strongly. But I think it is really an area in terms of Reg Show, in terms of T+1, in terms of transparency issues of impact investors. Those are all areas that if there is a policy change in response to that, it really should be done at the regulatory level. It's a very complicated area of the law that won't be resolved through a more general statutory change, but rather something that, should there be a regulator,
Valerie, you still there? I'm sorry we're having technical problems with Valerie. It's because she has so much to say. I'm hoping that we
Yeah.
can bring you back, Valerie. So I think to go back to Rob's discussion about people's peopleness,
People's
I think
peopleness.
I just I just love that. This is going to be a new phrase throughout the whole time
Oh yeah.
today. Um, but I think what's really interesting about this is this may be a new form of social activism. And what does this mean to us as investment advisors and to you as investment advisors? And looking at this, thinking about this, if you are a retail shop where you have retail clients, what do you do when clients call and say, look at GameStop. Look what's going on at GameStop. I want to be in. And what do you actually say to them in terms of suitability for them, in terms of getting involved in the social activism? Is this really part of the investment strategy? And I think this is something that really bears conversation with your investment advisor teams about how to handle conversations like this when you have clients that want to ride the wave, and they only, of course, they want to ride it on the way up rather than the way down. But I think it's something to really think about. Rob, what do you think about the way your team should manage conversations with clients that want to ride the wave?
Yeah, certainly it can be a pickle for an advisor and the firm itself to manage those expectations of clients, particularly when the client is driving the direction of wanting to be involved in these volatile markets and names. And so I'm reminded of times long ago when uh, the financial advisor would have a well thought out strategy and plan with the client that takes into account their risk tolerance and investment objectives. And largely, the financial advisor was directing the trades. And so those trades would be marked as solicited. And I think that's important for retail shops in particular to be careful and mindful of is how that trade is marked when it's executed. There needs to be clear instruction or at least counsel given to the client so that they understand the difference between solicited and unsolicited. That's important because I'm reminded of a time where this is shortly after the housing crisis in '08, and we were starting to see client complaints come in as to the money that they've lost in the market. And I remember one instance in which the financial advisor and his client had a relationship for many, many decades. And the advisor was never really meticulous about when trades were marked solicited and unsolicited. The client was often calling in and had his own ideas and wanted to execute trades. And when we dealt with the complaint itself, trying to put our story together or get our ducks in a row, if you will, we didn't have solid documentation about the conversations that that client and the advisor had. So the first point, in terms of practical application, I would advise any shop, particularly clients, compliance officers, to have that conversation with the financial advisor to make sure they're documenting the conversations with clients. And then second, marking the trade appropriately helps tell the story of when a client is involved the way they are. I find it funny that this client, um, after logging the complaint, said to me and an advisor in conversation, "Listen, there's nothing wrong with the relationship. I'm not mad at you, Mr. FA. I just need to get some of this money back, right?" And so when I think about the people's peopleness and the incentives and being frail and fragile, like Commissioner Peirce talked about in her speech, I'm reminded of this client who didn't see anything wrong with lodging a complaint against the firm and the financial advisor to try and get some of the money back. Now, because we didn't have the solid documentation that I would have advised the advisor to have in place, we did have to settle that complaint. But again, be meticulous about documenting client conversations, and also marking the trade appropriately. If it's truly unsolicited by the client, then it should be marked that way in your books and records.
So Rob, when that happens at your shop, assuming that it might happen at your shop, do you then charge fees on an unsolicited trade?
Well, because so that was my experiences over the years has been both broker dealer and investment advisor. And in my current shop today, we don't necessarily have that issue because we have total discretion over all our trades, and so our client and we're largely institutional based, and so that we don't really have that problem today. But in the past, I don't really recall whether there was I don't think there were additional fees charged for when it was solicited versus unsolicited. No, I don't think so.
So what many of our clients do is if they have an underlying retail client who wants to play in the market, they set up a separate account that that the advisor still reports on but doesn't manage, doesn't charge fees on. And then if the client were to call and say, hey, I want to ride this wave, then they could do this in their sort of quote play account. But I think it's
Sure.
tricky if, I think it's tricky if you're managing the client's account and they come in and say, I want to go into GameStop. And it doesn't fit the strategy at all. I think that's a difficult conversation to have. So
Certainly, and you make a very good point about the separate accounts. And also I forgot to mention that compliance officers might need to weigh in to that communication. I often would send written communication to the client reflective of the trading practices that I saw, and if they were divergent from their investment objectives and risk tolerance, then that communication would say so. But to your point, Linda, you're spot on. I think there should be a separation of the assets that the client is wanting to play with versus the advisor managing.
So thank you. I'd like to step back and Valerie, I think we were able to hear most of what you said, but I'd like you to repeat what you think may be the additional changes, the future changes as a result of this.
No, of course. And I think turning to the Gensler hearing, he's really focused on best execution in the face of payment for order flow and the tension between the two. So I would expect the SEC to begin examining that, whether through a working group, perhaps leading on to rulemaking. He was also focused on investor behavior and transparency, particularly with the use of apps. And then finally, how to ensure customers access to the markets when in the light of issues such as margin, which of course speaks to net capital issues and clearing issues. So I think those are the three areas we'll see separate coming from the SEC in the shorter term. Separately, the DTC's already spoken about T+1. That's not up to them alone. They need regulators to weigh in. When we switched to T+2, that took several years. The technology is there, but it's a matter of the firms aligning their technology as well as regulators changing several rules. But I do think we'll see a movement towards that as well.
Oh, I'm so glad we were able to hear you. Thank you. That's just really, really helpful.
Right.
It's like these these gems. It's like, ta-da. So going back to looking at this from an investment advisor firm perspective, I think that one of the areas to really look at is your personal trading policy. And I think this brings up all kinds of questions about supervision, and are you going to create a restricted list, which includes issues like GameStop, which is going to be difficult because I think recently there were 15 issues, 15 really lower valued issues that the SEC stopped trading on. I think it was even last Friday. So do you make every issue that you think is a potential GameStop to go on the restricted list? That doesn't make any sense. But as you look at personal trading, I think if you see personnel who have participated in some of these run-ups, are they doing, is this interfering with their work time at work? Is this inappropriate thing for a client, for personnel to be doing? Um, and I think it's really worth having a conversation with all of your employees who are reporting their personal trading about what the firm's policy is on this. And you can be very conservative, you can be very liberal, but I think it's important to have a firm policy on participating in something like this. And I think Rob's going to weigh in on what this means in terms of personnel participating in social media pertaining to their personal trades, because I think that's a question now that comes up that we frankly haven't really had to deal with very much in the past. It's been more isolated, but I think if this is truly a socially active method of trying to manipulate the market, how is the firm going to discuss this with your own personnel? So Rob, talk about this a little bit in terms of social media and what you see changing in advisors' policies as a result of this.
Yeah, sure. To boil it down into a soundbite I think, is to capture or not to capture, right? I look at social media as it relates to our industry in three buckets, if you will. There's the personal use of social media. That's, it's Facebook, it's Instagram, it's friends, family, things of that nature. There may be some mention of what you do on those sites, but it's largely devoid of what you truly do on a day-to-day basis in your professional capacity. Right? I don't necessarily see the need for capturing there, but with a caveat though. The second bucket is the professional use, and that's the LinkedIn pages. You start to get into some gray area there when individuals or your employees are not only putting where they work and what they do, but their full resume is there, and it invites conversation with those who are following them as to what they do. And you've got to be careful there. That gray area can turn very quickly into, do I have a books and records retention requirement based upon the communication in that discussion on social media? And so then there's business use, if you will. And business use is squarely in the crosshairs of books and records. It's the employee is using that in that social media page to advance their profession, advance the business that they're conducting on your behalf. And so when I think about the GameStop and Reddit issue, there was an individual who was a registered representative and was using social media to kind of talk about what he was experiencing. I think that crosses that gray area into, when you're using it from professional use, even though it's professional use, you're registered, maybe firms have to capture that page. Capturing the page will allow the compliance officer to, one, meet the books and records requirement, but two, gives them insight as to what's really going on, to know whether they need to apply the personal trading policies to the activity that may be going on in that professional use page. So again, to capture or not to capture, we're in a pickle in terms of trying to figure out exactly where we need to go there, because again, peopleness will say, hey, why are you capturing my page, my professional page? I'm not advocating on behalf of the firm. I'm just trading in my own account. Why are you wanting to capture my professional page? It's murky, Linda. It's gray, and I think we've got a tough road to figure that out.
Well, and going back to the discussion about this broker, I understand that all of the users on Reddit, which was the primary vehicle for this discussion, and in terms of social media, everybody was using pseudonyms. And does that make a difference? I think there are some very significant privacy issues here, and Valerie, with I think you have some comments about what some states are doing in terms of privacy and use of social media.
That's right. Back in 2012 to 2014, there was a wave of state social media privacy laws. They've been adopted in about half the states, in half the jurisdictions in the US. They do exclude professional financial services communications that need to be captured, like Rob described. But with users posting anonymously, we are unfortunately starting to get back into a gray area that exclusion was meant to cover. I do still think that exclusion should cover exactly the type of communication Rob said should be captured, even if the user is anonymous. The rep should be reporting it to the firm, and the firm should be able to supervise it. But I do want us to all be aware that these state social media privacy laws exist and that only about half the jurisdictions have it. This may be exactly the type of event that would cause additional state legislatures to become interested in adopting the model that exists now. That was adopted by the Uniform Law Commission in 2016.
So what you're suggesting then is so this would be based on where the employee actually lives, right? It would be the state of residence of the employee. So that means if the
If the
firm
state has the law.
right, right. So that if a firm wants to adopt the policy that you have to report any discussion of any trading, whether it's trading the firm is doing or trading you're doing on your personal account, whether it's by your name or with a pseudonym, if you're going to adopt that as a policy, you need to check with the state laws for
Wow.
social media privacy.
You do,
Wow.
and
That's a
there
big
is
one.
a built-in, there is an exclusion that is in these statutes that already exist. But because of the anonymous nature and the fact that a rep would argue they were doing this on a personal level, that is going to make that more of a challenge. And it's something to be aware of as a firm. And it's also something to be aware of that there may be changes in terms of these social media privacy laws moving forward.
Oh boy,
A
more
state by state
regulation.
policy on social media. That's going to be a bear for compliance programs to manage. There has to be something to set the stage for how we approach that on a more consistent basis.
I don't think we're there yet, Rob. And based on the work that occurred a few years ago for that first set of laws, it's not, firms do not have to approach it on a state by state basis because the exception for financial services record keeping is uniform across these statutes. But it is
Okay.
something to be more aware of now more than ever. That's really what I'm getting at.
Yeah, sure.
Oh boy. So Alex, I think we've tried to leave some time for questions, and I would be stunned if there aren't any.
Well, there absolutely are. I've been keeping an eye on the chat, but first, I think we skipped over an important piece of information at the beginning. So for those of you that are looking for the continuing education credit, the first code word was game. Game, G-A-M-E. And now we're obviously to the end, so you're about to get the second one, but pretend we gave you the first one 50-ish minutes ago. So for the first question, actually, it relates back to the conversation that you and Rob were having, Linda, about dealing with customers who may want to get into GameStop. The question is, have you had any experiences also dealing with the employee side of things? So the question asker posed that they have a 60-day holding period and one of their employees wanted to sell out of GameStop within days of making the purchase. The compliance department said no, obviously, and they're wondering if you have had any similar experiences or thoughts on kind of managing the employee side of things as opposed to the client side of things.
I think we covered that somewhat. Rob, or Valerie, do either of you have anything to add to what we said earlier? I think a
Yeah,
holding
I
period is
might
a really
add.
good idea.
Yeah.
Go ahead.
Yeah, a holding period, yes. I don't know. To be very candid about that, I think we wade too far into the employees' personal investment objectives and things of that nature. I think it might be accomplished similarly by having a trading limit to the number of trades that a person can make.
Mhm,
Right
mhm,
now,
mhm,
if you're wanting to curtail the activity such they're not using spending time that the company is paying them for to trade their personal account, then that limit might accomplish that. But by having a do not sell within a certain period, I think that's getting at the same time. You don't want them day trading ultimately.
right.
So I think if you had a limit, I think that might accomplish the same thing, and you're not necessarily wading too far in that gray area of the employees, um,
Mhm,
because essentially, if
mhm.
you're telling them they can't trade within a certain time, you're saying their investment objectives and risk tolerance should be set a certain way, and I don't know that that's the spirit of what you were trying to accomplish with that policy.
Mhm, mhm, mhm.
I wanted to go back to Valerie because there was a piece that we wanted to just touch upon with of quant shops because we talked about retail shops, we talked about employees, and I'd like to hear what you have to say about quant shops and the data analytics ability that the SEC now has.
No, I think Linda, that's exactly right. And I'm glad we have the time for it. The SEC's data analytics have really become ready for exactly situations like this. We've seen matters with our clients where, for market movement type issues, the SEC will catch those and then will open an investigation and want to have a discussion with the firm about what occurred, what were the policies and procedures, who was affected, and their data analytics have just improved so much since the last time we had such market volatility in, the last financial crisis, and every sort of market volatility period since. We've seen the data analytics that the SEC has be even more on top of its game, and I think we're just seeing that now. The timing is great for the SEC. They have all the tools. They are focusing on technology. They are focusing on market structure more than ever. Gensler will spoke to the importance of market structure in his confirmation hearing. So I think there will be more to come with these issues. I think quant shops that are making large trading decisions need to be aware that this is in the background, and they need to have their policies and procedures and frankly their process in place, because they could find themselves answering questions very quickly.
Mhm, mhm. Valerie, while we have you, one of the questions actually was specifically for you, and I thought you might want to comment. Do you think there will be enforcement actions by SEC, Finra, or state regulators as a result of the GameStop saga?
Yes, their investigations have already opened. There's a lot of interest, and there's interest across the regulatory community. I am hopeful there is regulatory coordination, but frankly, this is the type of issue where every regulator is going to want to be involved. So the challenge of managing those investigations in terms of the number of regulators alone will require a very deft touch. And that's before we even get into the substance of the questions from each regulator.
Right, right. Great. And Rob, maybe one last one for you. In regards to social media, do you see there being an expectation to solicit an employee's entire social media presence into the future? So knowing the full picture for each employee.
I think that's what I was touching on before, where there's that gray area of do you capture or not. I think for registered representatives, there may be the need to capture, because I don't know that you can separate what they do personally from professionally sometimes. I mean, I was an advisor early on in my career, and I played in the traffic all the time. Anytime I was in the public, going to the grocery store, taking out the trash, I was always a financial advisor. And so for registered reps, I think that puts us in a conundrum. I think perhaps social media pages need to be captured for all registered reps. I know I'm going to get a lot of hate mail for saying that, but there's that gray area of do we need to capture that? But I think with seeing the events of GameStop and the registered reps that were involved, it may need to be captured for registered reps.
So 10 seconds, Alex, are there new developments? Is there more to the story? Are we near the end of the story?
Absolutely. Well, one new development we can obviously expect and look forward to is the hearing later, second half of the hearing later this month on March 17th, continuing the hearing that Valerie discussed earlier. But I expect we'll continue to see some activity in GameStop during that period, and potentially even beyond as we figure out what it's going to mean into the future.
I just want to thank all of us and every one of you on the panel, and I want to thank all of you out there listening to us. Please visit us at the Bates virtual booth or online afterwards. And we are going to be available during the 2 later breaks today on Zoom through the Bates booth. So feel free to reach out to us, and thank you again.